Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you actionable insight on everything mutual fund related. And if you've got questions for us, then send them to us on that WhatsApp number that you see on your screen. But do remember to tell us what your goal is. Usually, you have to match your investments to a goal. Now, on today's program, I'd like to talk to you about mid-cap funds, actively managed mid-cap funds, because I was thinking about it, and often we talk about large caps and how your passive strategies are probably better than active strategies in a lot of cases, though over the last years you have active strategies that have beaten the passive strategies. On the small cap, you say how it's very important for building long-term growth, but we don't talk about mid-cap very often. What is the role that it has in your portfolio? Do you really need it? And so, how do you go about choosing that investment? Should you invest in it at all? To talk about all of this and more, I've got Varun Fatehpuria, who is the founder and chief executive officer of Daulat Wealth Management, as well as Pankaj Mathpal, who is the founder and chief executive officer of Optima Money Managers. Thank you so much to the both of you for taking the time. Varun, I'll start with you first. I took the liberty of putting together some data points to say, would a combination of large cap, mid cap and small cap beat a combination of large cap, flexi cap and small cap over the last 3 to 5 years? And the answer is yes, it actually would. The only thing that would outperform it would be a multi-cap strategy over the last 3 years. And that's because it has a reasonable allocation to all three. What role, according to you, would a mid-cap fund have in a portfolio?
Hi, Alex. Good afternoon. Good to be talking to you again. As we correctly mentioned, I think mid-cap is something which is not often talked about, though having seen the kind of performance that most of the category and the schemes have delivered, I think it definitely warrants a look at this category. As we all know, mid-cap, the category itself represents the top 150 companies from a market capitalization perspective, post the large cap. So companies from 101 to 250 actually represents the mid-cap companies. And these are in some sort of a very good sweet spot that it offers you that growth potential, which the small cap category is known for, but at the same time, with some sort of an established track record and the stability which the large cap category is suited for. So it is a good mix of both strong earnings potential, growth potential, but at the same time, some sort of a stability and a track record. To your specific question with respect to you, why a combination of large, mid, and small have actually performed, a combination of, let's say, large, flexi, and small, or large and small, has to do with a couple of reasons. Number one, the category itself, both the small cap and mid cap funds have performed exceptionally well over the last 3 to 4 years, delivering in returns in excess of 20-25%. And that is the reason why we see having an allocation to mid cap and small cap has led to that kind of outperformance. And number two, most of the flexi cap funds today in the category actually run with a very strong large cap bias, right? Even though they have that flexibility to move around from large to mid to small, we have seen that on an average basis across the category, most of the fund managers actually have a very high allocation to large cap. So it is really a quasi large cap allocation from a flexi cap perspective. And that is the reason why having an allocation to mid and small compared to just flexi or large and small itself has led to that kind of outperformance over the last 3 to 5 years.
Pankaj, what's your view? Would you add to that lower volatility in certain cases, lower potential for significant drawdown, and also lesser, of course, reward potential compared with small cap? What role, according to you, does mid cap have?
Good afternoon, Matthew. See, as mentioned earlier, it is a correct thing because these mid caps have better growth potential compared to large cap and less volatile compared to small cap. And I'll tell you, there are few sectors where you'll find that these mid caps are more compared to large cap. For example, chemical, pharma, or consumer durables. So if you want exposure to these sectors where you find better potential, then mid cap should be in your portfolio. So though I'll say in long term, you must have investment across market segments. But yes, you cannot ignore mid-cap in your portfolio because of these two reasons, as I mentioned. One is that growth potential, and second thing, less volatility compared to small caps.
Fair point. I was actually looking at multi-cap performance as well, Varun, and it stands out as a significant outperformer simply because the fund manager is forced to buy 25, 25 and 25, at least in mid, small and large, and that forced diversification has resulted in an outperformance. But is that also a potential problem going down the road, because we've seen only in the recent past some drawdowns in the broader market? So can you substitute this requirement to have an equal allocation, large, mid and small, by using a significant portion of your proceeds to put money into multi-cap?
So obviously, Alex, what you tell me is something which a lot of investors actually partake in, where they need to diversify their portfolios. And then a simple, obvious way to do it is to go and allocate it equally across large, mid, and small, 33% perhaps each, right? I mean, from a diversification point of view. If you look at it from a multi-cap perspective, yes, I mean, the fund managers are forced to allocate a minimum of 25%, and the remaining 25% is something that they are free to tinker around with. They do not have so much of the flexibility. And because of the run up that we have seen in mid and small, is the reason why we have also seen a lot of the multi-cap funds actually outperform the Flexicap category, which again tends to run with a large cap bias. Investors, I would say, if we were to take my view on this, most of the time they're actually better off putting money into, let's say, a multi-cap category, primarily because they get that diversification benefit, but also they do not have to do that rebalancing every 3 months, 6 months with their portfolio without having to incur a significant tax outgo. So in that scenarios, yes, someone who is a do-it-yourself investor do not have the bandwidth to track markets and the relative performance of the market caps. Over a longer period of time, you will end up seeing that on a risk-adjusted basis, multi-cap funds will end up outperforming your own diversified portfolio.
It's an interesting perspective. But Pankaj, would you agree with that? And if so, is one multi-cap enough to serve the purpose, or would you have multiple multi-caps?
Not multiple multi-caps, but I say that in a portfolio, there is a scope for multi-cap as well as flexi-cap. See, multi-cap, the limitation is that you have to have 25% allocation in each market segment. Only 25% of the AUM can be decided by the fund manager, means flexibility is limited. But when it comes to flexi-cap, fund manager has flexibility to allocate in a market segment based on the market situation. So in this case, see, it may be flexibility can be good or bad depending on the wisdom of the fund manager or the call taken at the time. See, for example, if suppose you are you have allocated more in large cap and small caps are performing better, then you may lose that opportunity. But at the same time, if your decision is correct, you may outperform the multi-cap. But in multi-cap, because you have to have allocation across the market segment, so maybe that in long term, you get average returns of the market. So what I would recommend that one should not have two multi-cap. Instead, if one has one multi-cap and one flexi-cap, so you can get benefit from the both strategies. So that will be my recommendation.
Okay. All right. I want to steer the conversation back towards mid-cap, because ultimately, I take your point, Varun, and on a risk-adjusted basis, somebody would find it easier and more tax efficient to put money into a multi-cap. But let's assume that the individual has some insight and is using the conversation that we're having today also to make a more informed decision about where to invest. I've pulled up the top performers in the mid-cap category over the last 5 years. I want your view as to what stood out about the decisions that these fund managers made. You have, in effect, we'll pull that on the screen, you have Quant Midcap that is topping the list, 32.2%, and this is as of last week. Motilal Oswal also doing particularly well. And this is actually a turnaround over the last year and a half or so. You have Edelweiss Midcap, you have Nippon India Growth Fund, and you have the HDFC Midcap Opportunities Fund. Several very large fund houses in this list of top 5. What has stood out about these strategies, Varun?
So, Alex, as you point out, obviously, I mean, if we look at it from a mid-cap perspective, most of the actively fund managers have found it really difficult to beat the benchmark, right? I mean, the common notion that it is difficult to outperform the benchmark on the large cap strategies stand true, but that has been the case in the mid cap segment as well. And all the names that you point out on the screens are just a handful of names. If you look at it from a 5-year perspective, have actually been able to beat the benchmark. Just to give you some perspective, I think on a 5-year period, close to about only 22% of the funds have actually outperformed the benchmark from a basket of about 25 to 27 schemes, right? So yes, it has been difficult for fund managers to today to beat the benchmark, and specific to the funds that you have mentioned, a lot of it has to do with the high active share or the percentage of the portfolio which is different from the benchmark. And these funds have taken that call. They do not follow a very benchmark hugging strategy. They run a concentrated portfolio. Let's say, for example, the Motilal Oswal Midcap Fund, which has really seen a turnaround over the last 12 to 18 months after the fund manager has changed, running concentrated high conviction portfolios of 25 to 30 stocks, right? Having a high active share relative to the benchmark, participating in sectors which are slightly underlooked or let's say under researched by most of the research community. These are the few reasons why you think most of these funds up on the screen have been able to beat the benchmark, which is not the case for, let's say, the vast majority of the other schemes.
Speaking about the vast majority of the other schemes, and speaking specifically about the underperformers, we pulled up the 5 worst performers as well over the 5-year period. And incidentally, gentlemen, we've been getting questions about some of these schemes in particular. DSP Midcap has underperformed, Taurus, Franklin, LIC and Axis Midcap. Pankaj, is this also related to, as it has been pointed out by yourself and by many of the experts on this program as well, the strategy and the time in the cycle that we are currently in, and the fact that some of these calls have gone very wrong?
That is true. See, call have gone wrong, or sometimes what happens, because when we talk about mid cap, as per regulation, minimum 65% allocation has to be in the equity related to mid cap shares. So sometimes what happens, the fund managers, they invest in some scheme, you'll find that 80 to 90% allocation is in mid cap only, but in some schemes you'll see that there is an allocation in small cap or sometime in large cap. So that deviation will also result into the performance. So it depends that what strategy you are following. And second thing, that whether you have a diversified portfolio or you have a very focused approach, that kind of strategy you are following. So it depends that what goes in your favor. So every fund manager wants to outperform the benchmark, but sometimes the strategy which is adopted by the fund manager may not result into the performance.
Fair point. What would you do in a scenario where you've had, Varun, patience with an underperforming scheme? Because often it is said that you don't judge a fund based on its performance simply over 3 years. But then some schemes, even on that list, have underperformed for more than 3 years. At what point do you draw the line then and say, this is not working, I need to switch out?
So Alex, I think that is where fund selection and your fund selection criteria parameters come into the picture, right? A lot of the investors today would go out there, maybe look at a fund from a 3 or 5 year perspective, right? And maybe in hindsight, on a 3 or 5 year basis, some funds could outperform the benchmark, maybe due to a good 1 year. But what we recommend investors is rather look at consistency of performance on a 1 year rolling basis. So rather than picking funds which operate on the extreme, maybe look at funds which are out there in the top quartile, but delivers that consistency of alpha year on year. I think that will basically increase your chances of staying invested with the fund. No matter what advisors, wealth managers, or even investors, it's not really comfortable to see your fund consistently underperforming the benchmark or a category on a year-to-year basis. So what we would advise investors is to see if there has been a trend of consistent underperformance both relative to the benchmark and the category itself, then definitely that fund warrants a second look. Having said that, investors need to also keep in mind that has there been a significant change in the fund manager or the fund investing style due to which that underperformance is coming into the picture, and then tie those things together up in taking a decision whether to stay invested with the fund or whether they should exit. If they need to exit, they need to also take into account the tax
I
considerations
was going to come
which come
to
into the picture.
I was going to come to exactly that. So Pankaj, why don't you take the answer to this question, which is that if somebody is decided, and also would you be able to weigh in on when you decide to say this scheme is no longer working, I'm going to advise my clients to not invest or shift out of it. What degree of underperformance? I take the point on the 1 year rolling, but what degree of underperformance would you have that qualify for being struck from the list? And how do you navigate the tax aspect? Because assume that somebody is investing for 5 years or thereabouts and then seeing an underperformance, chances are that you have a significant amount of capital that has been accumulated. And even in a case where you're talking about an underperformance of midcap, the lowest performer is still 20+% over the last 5 years.
See, Alex, whether it's you mentioned 5 years, but I'll say even for 3 years, if the scheme is underperforming its benchmark or category performance, there is no reason that you should stay invested in that scheme. See, for some time, maybe 1 quarter, 2 quarter, I understand that strategy is not working well, but ultimately, if I'm suggesting somebody or I have been investing in a scheme, the objective is to get returns. If the strategy of the fund manager is not working in my favor, why should I stay in that scheme for so long? See, tax definitely means I may have to pay tax when I redeem units. But if I stay invested and not making profit in that investment, so better I pay tax, book that profit, and stay and switch the scheme, and I even recover that loss, means in the form of tax what I have paid in long term. So my suggestion would be, if the scheme is consistently underperforming and even fund managers are not making changes to improve the performance, it is better that you switch to the better performing scheme and do not worry about the tax payment, because in long run you will recover that loss.
But you didn't answer what degree of underperformance is okay. Of course, it would depend on the category, but since we're talking about mid-caps, what degree of underperformance, Pankaj, would be something that is a red flag?
It's simply that what tax you are paying is a long term or a short term, because we are talking about long term only. So what tax you have been paying on the redemption, that you have to consider. So if you feel that after payment of the tax, also you are in profit if you sell it and invest in some other scheme, so that much you have to consider. That's it.
Okay, all right, fair point. Let's jump into some of the queries that have come through, and there are quite a few that have already come in. I would like to remind you, if you're tuning in, if you've got questions for us, that you can send them on the number that will soon flash on your screen, but tell us what your goal is as well. Saurav Das has got the first question. He's investing 50,000 rupees per month in SIPs in a few schemes, and he's asking, is his portfolio heading in the right direction to achieve a 2 crore portfolio over a period of 15 years? He's 45 years as of now, and he's currently investing 50,000 rupees per month. The schemes are, and Varun, I hope that my team has sent it to you: ICICI Pru Value Discovery, Nippon India Multicap, HDFC Flexicap, HDFC Midcap Opportunities, Parag Parikh Flexicap, and HDFC Balanced Advantage. So 6 funds he's got. I do not know what kind of split it is of that 50,000 rupees, but then it's a pretty diversified portfolio, wouldn't you say?
Right. I think just from a fund selection perspective and also the number of schemes in the portfolio, I think Saurabh has done a very good job over there. Right. Again, not really knowing what the allocation is there to each of the specific schemes, but just looking at it from an overall basket. Very good portfolio, well diversified, not overly concentrated on a particular sector or a theme or a market cap. And the amount that you mentioned, sort of 50,000 rupees a month for the next 15 years, you'll easily be able to achieve that 2 crore that you have as a goal in your mind, the only suggestion would be to do a small step up or a top up SIP every 6 months or 12 months, depending on your comfort level in the range of 5 to 7%. So that you're maybe even achieve that goal even faster.
I'm guessing that this is because they want to achieve a retirement in 15 years because they are 45 years old. Sort of, I know that a lot of people, sorry, Pankaj, a lot of people come up with arbitrary numbers, and I hope that this is not the case with sort of any advice that you would give to that end. He's put 2 crore and what you would need in 15 years.
That how much you spend now, because based on that only you can calculate that how much you will need at the time of retirement. But one has to understand if the inflation is considered even at 6%, your 2 crore rupees will be 1/3 of what it is today after say 15, 20 years. So whenever you set a target, you must factor in inflation. That is one point. Second thing about the portfolio also, if I want to add to this, they see as Saurabh mentioned, the schemes are really good. I agree with Saurabh here. Varun, I'm sorry. As Varun mentioned, I agree with him. But only thing is that because a long-term portfolio, and he has, Saurabh has HDFC Balance Advantage Fund in portfolio. So if he switched to an international fund, which is missing in his portfolio, that can be a good idea. So I would suggest that Motilal Oswal Nasdaq 100 Fund of Fund can be considered. That will provide a better diversification to this portfolio.
Okay, fair point. Riffin has got a question. He's 30 years old, and again, his goal is to build a 2 crore portfolio. Riffin, if you're 30 and if you're investing 33,000 rupees per month right now through SIPs, I think you should dream much bigger. Varun will be able to tell you. He's looking to invest through SIPs, and he's asking if he's on the right track. Would you also be able to give him some advice as to where he should split this 33,000, Varun?
Obviously, I think the biggest advantage that you have is that you have time by your side, right? You have an easily 12 to 15-year horizon in front of you. And given your age, right, obviously today, given what the market conditions are, obviously, I think we'll construct portfolios, let's say, with a slightly higher large cap bias. In the large cap category, you could look at something like an ICICI Pru Blue Chip Fund or a DSP Top 100 or the HDFC Top 100 Fund for a large cap allocation. In the Flexicap category, you could look at a JM Flexicap or a Parag Parikh Flexicap and keep your allocation to large cap today at about 65 to 70%. I do not have an understanding whether you're doing this for the first time or you have seen the volatility of the mid cap and the small cap segment. But if you continue to put in into both of these categories through an SIP over a 7-year, 10-year period, then I think you should be okay. And maybe today allocate about 25-30% of your portfolio to mid cap and small cap, and maybe if you see a further correction down the line, try increasing that number slightly. But so in the mid cap category, you could look at a Motilal Oswal mid cap fund or a Nippon India growth fund. In the small cap category, you could look at a Bandhan small cap fund or the Nippon India small cap fund as well. And then, as Pankaj mentioned, maybe have a 5 to 7% allocation to the international portfolio as well. So creating this basket of schemes across different market cap strategies and geographies will definitely help you reach your goal of 2 crores in the next 15 years.
Okay, so there's one thing I didn't ask the two of you in the mid-cap category. We've only spoken about actively managed schemes, but there are not too many options available in the passive side, but there are still a couple. Varun, any thoughts about whether you can look at passive in this category now?
Again, Alex, I think, if you just see the numbers, right, today, obviously, there has been a significant underperformance over a 3 or 5 year period. But I think that also has to do with the function of the market itself, the indices itself over the last 12 to 18 months, where actively managed fund managers have had a difficult time to deploy that incremental monthly flows that they are getting through SIPs every month, right? Maybe due to a lack of opportunities or maybe due to certain parameters which does not fit what they look in a particular stock. So today I would, let's say, continue to advocate to having a allocation through an actively managed route in the mid cap category. If someone has a sufficiently longer time period. And maybe in today's market, as we speak, the kind of correction that we are seeing over the last 1.5 months, right? This is where the actually proof of the pudding comes of the actively fund managers, where they are able to actually find opportunities, let go of opportunities where they find the valuations a bit frothy.
And downside protection ultimately is the true blue test of a fund manager, Pankaj. So therefore, in these tough times, that's when they shine. And so therefore, from that perspective, would you say at all that you should consider a passive strategy in the broader markets?
Actually, when it comes to large cap, I prefer that investment in index funds. But when you talk about small cap, mid cap, actively managed funds may be a better choice from the risk management perspective. The reason is that in index funds, the rebalancing is allowed once in a 6 month, means semi-annually basis, rebalancing is done. But in active funds, fund managers can decide the frequency. So sometime if required means there may be frequent changes in the portfolio. So in long term, I feel that in mid cap category, that actively managed funds may perform better with a better risk management.
All right. Pankaj, Varun, thank you so much for taking the time speaking to us on NDTV Profit, and thanks so much for joining us on the Mutual Fund Show. All right, and that's all we have for you on this edition of the Mutual Fund Show. As I always say at the end, of course, let us know what you think in the comment section and tell us what questions you have. We'll take them up over the course of the week. Do stay tuned. This is NDTV Profit.